డాక్టర్ బిఆర్ అంబేద్కర్ సార్వత్రిక విశ్వవిద్యాలయ విద్యార్థులకు స్వాగతం.
Hello students, this lesson on investment appraisal methods is intended for the MBA students of Dr. B.R. Ambedkar Open University. Once an individual or a firm or a company has decided to do business in a specific area, it needs to acquire assets to do such business. When the business is planning to acquire assets, it is involved in the investment decision. This decision is also popularly called capital budgeting decision. This decision is very important because it relates to fixed assets. It is about the capital expenditure decision and it is also called the management of fixed assets. The main characteristics of this decision is that it has relatively very large anticipated benefits and the time gap between the outlay and the inflows is huge. Therefore, there is a relatively high degree of risk. These decisions are not quickly reversible because they are the true or earning assets of the firm and they are also the strategic investments. They have an bearing on the profitability of the firm, and because resources are scarce, huge investment must be carefully done, and sometimes a single mistake can cost survival of the business. The difficulties which are associated with this decision are it relates to future and future is uncertain. While every effort is made to estimate the cash flows, there is a risk that the estimates can be wrong. Also, there are certain extraneous factors like pricing, advertising, promotion, shift in consumer preferences which are extraneous, and also technological developments which may have an impact on the investment decision, and the cost and benefits are not comparable because they occur at different points of time, and sometimes the costs and benefits may not be strictly quantifiable. Why do firms take capital budgeting decision or the investment decision? Mainly to improve efficiency, to increase the profits through either expansion or adding a new product line. Sometimes the investment decision may also be for decreasing the cost in order to maximize profits. The investment decisions such as these relate to reduction of cost either by replacement. The firms take capital budgeting decisions which could be simplest capital decisions like accept reject decisions, wherein you choose an asset or reject it, or it could be a mutually exclusive decision where you have more than one acceptable project but you can choose only one. When you take one project, the other automatically gets excluded. The third type of a capital budgeting decision or an investment decision is such where there are more than one acceptable projects but then the capital available is limited, so you ration the capital available between the projects. The data which is required to take these investment decisions or capital budgeting decisions is either the cash flow or the accounting profit. We always estimate what are the costs associated with the investments and what are the benefits which are associated with the investment. So either you could take cash flow or accounting profit. The only difference between accounting profit and cash flow is accounting profit is a result of your profit estimates, which is an output of an accountant's estimates, and there are certain bias which are associated with profit, whereas cash flows are real cash flows and they provide a superior data for investment decision. But while we are depending on cash flows, we have to remember that we only have to take the incremental cash flows. For example, if you are doing a new product or a new business in the same premises, You may not need to pay the extra rent. If such is the case, it becomes a fixed overhead and you need not consider rent in such case. But if there is an increase in rent, that rent becomes an incremental cash outflow. You also need to take care of depreciation. Depreciation is a legitimate deductible expenditure. It reduces the tax payable and also it reduces the outflows, so it should be considered while estimating the cash flows. There are several investment appraisal techniques which are available, investment methods. We divide them for convenience into two categories. The first category is the traditional category and the second one is the sophisticated category. The sophisticated category is also called the time adjusted decision making techniques or the discounted cash flow techniques, popularly called DCF techniques. The traditional methods are the payback method and the average rate of return. Discounted cash flow techniques are NPV method, internal rate of return method, profitability index and terminal value method. The payback method, which is the traditional technique, is the time taken by the project to pay back the investment. Therefore, it is named as payback method. It is the simplest method and most widely used method. Now, if you take an example on the payback method, the outflow on a particular project is estimated at 1 lakh rupees and the yield is 25,000 for 5 years and thereafter 34,000 for 4 years. What would be the payback period? Obviously, the payback period would be 4 years because your investment is coming back in the 4th year. When we look at the payback method, in this present problem, we see that we are getting our cash flows paid back in the 4th year, which is highlighted in yellow. In this problem, the first year's cash flows were 20,000. In the second year, it was 25,000. So, the cumulative cash flows for the second year are 45,000. In the third year, we got another 35,000, which makes the cumulative cash flows 80,000. And at the end of the third year, we still need to get 20,000 as our investment. So, this is getting recovered in the 4th year where we are getting 40,000 as cash flow. Assuming that the cash flows are occurring evenly throughout the year, we find that we will be paid back this investment of 1 lakh rupees by 3 years and 6 months. That is, the payback is 3.5 years. If the cash flows are not even but they are uneven, this is how you calculate your payback period. In this particular problem, you have a situation where you are getting 20,000 in the first year, 25,000 in the second year, 35,000 in the 4th year and so on. This is how we compute the payback period. Moving on to the advantages and disadvantages of payback method, you find that payback method is the easiest by far to calculate. But the disadvantage is that the payback method is only trying to recoup the investment. If you are in business, you should try to get a profit and not only recoup the investment. Whereas the problem with this method is it only tries to get the investment back. Therefore, you are not actually looking at the post payback cash inflows. This is a major difficulty with payback method. The third difficulty with payback method is it does not consider the time value of money. Coming to the average rate of return, this is based on accounting information rather than cash flows. That's why we call it accounting rate of return. Now, in this we see that the accounting rate of return is calculated by dividing the average profit by the average book value of investment. Look at this example. You find that the average annual profits after taxes are 36,666 rupees, whereas the average investment over the life of the project is 1,12,500 rupees. Therefore, the accounting rate of return is coming to 32.59. This rate of return is compared with the predetermined minimum rate, and if this 32.5 is more than the predetermined rate, we accept this project. In case of mutually exclusive decisions, we will rank the projects and accept the one which is the highest. Now, when it comes to average rate of return or accounting rate of return, we compare the ARR of the project with the predetermined minimum rate. If the proposal is giving better return, it is accepted, otherwise it is rejected. In case of mutually exclusive decisions, the one with the highest ranking is accepted. Now, these are the benefits and disadvantages which are associated with average rate of return method. Have a close look at it. It is easy to calculate. The data is easily obtainable. It is easy to understand, and you are using all the benefits which are arising out of the investment. The disadvantages are it is using accounting profit rather than the cash flow, and it does not consider the time value of money. Moving on to the sophisticated techniques, we have the net present value method, which comes first. We calculate net present value by first selecting an appropriate rate of interest, which is called the opportunity cost of capital. Then we calculate the discount factor for each of the inflows. We multiply the discount factor with the cash inflows to obtain the present value of cash outflows. Lastly, we deduct the present value of cash outflows from the present value of cash inflows in order to obtain the net present value. Look at this example. Here we see that in the first year we are getting a cash inflow of 900 rupees, second year 800 rupees, 700 in the third year, 600 in the fourth year, and 500 in the fifth year. Looking at an opportunity cost of capital of 10%, the discount factors stand as 0.90909, 0.82645. After obtaining this discount factors, we multiply the discount factor with the respective cash flow, obtaining the present value of cash inflows. We now summate these present value of cash inflows, and we find that the total present value of the cash inflows is 2,725 rupees. When we deduct the present value of outflows of 2,500, we have an NPV of 225. Because this is more than 0, this project is acceptable. The major advantage of this method is it considers the totality of benefit, it considers the time value of money. It is not very difficult to calculate, but the relative disadvantage is compared to payback method, it is more difficult to calculate. Have a close look at the advantages and disadvantages of this technique. Moving on to internal rate of return method, which is the second sophisticated technique, right? We see that internal rate of return is just like the net present value method. However, in the net present value method, we are taking a discount rate which is predetermined in order to discount the cash flows. Whereas in IRR, we arbitrarily take a discount rate and try to see at which rate the net present value would be 0. That is, the internal rate of return is defined as the rate of discount which equates the present value of inflows with the present value of outflows. The steps to calculate IRR are that you select any rate, compute the PVs. If the calculated present value is lower than the expected present value, we use a lower rate to discount and vice versa until the NPV is equal to 0. Look at this example. Once this is done, because we have got an IRR which lies between 15 and 16%, we actually try to extrapolate the accurate internal rate of return this way. That is, lower rate at which we have discounted the cash flows plus the difference in cash rates multiplied by the NPV at the lower rate by the NPV sum of lower rate and higher rate put together. We always compare the IRR with the rate of return which we have had as a hurdle rate. If R is greater than K, we accept it. If R is lesser than K, we reject it. Alternatively, we can also use this formula in order to calculate the IRR. If we have to evaluate the internal rate of return method, the advantages are that it considers the time value of money, It considers the totality of cash flows. Managers find it easier to understand than NPV because it is a rate, and instead of having a predetermined rate, it generates its own rate, and it is consistent with the objective of maximizing the shareholders' wealth. The difficulties: it involves tedious calculations. Sometimes it gives multiple rates of internal rate, which leads to confusion in case of non-conventional flows. Sometimes the one with the highest IRR may not be the most profitable, as we see in this example. And the last problem with IRR is that the funds which are reinvested may not be reinvested at the same rate of return. Moving on to profitability index, we see that the profitability index is also a time adjusted method. It is very similar to NPV method, and the steps in calculating the profitability index is the same as the NPV except the last step. The reason: while NPV is an absolute measure, the IRR is a relative measure. We calculate profitability index by dividing the present value of cash inflows by the present value of cash outflows. The accept reject rule for profitability index is: if the profitability index is greater than 1, it is accepted. If it is lesser than 1, it is rejected. Look at this problem. You see here that machine A is giving you a profitability index of 1.239, whereas machine B is giving you a profitability index of 1.272. Therefore, we accept machine A, whereas we reject machine B. If we have to consider the technique, we see that it considers the time value of money, it considers the totality of benefit, and it is said that this method is better than net present value method in case of capital rationing situations. The disadvantages is, just like NPV, it has more calculations and people may find it more difficult to understand. Now, when we come to the limitations of capital budgeting decision, we see that all the techniques which we have used so far have always depended on quantitative information, but in real life there may be real options, such as your project might give you NPV in the first stage, but later on, if you stay put in your business, you may be able to expand your business, wherein you might be able to have a positive NPV and a greater NPV which is available in the first place. Sometimes we often consider that we should be the first movers in any business, and if you want to be the first mover, probably your project is giving you a negative NPV. But in real life, there may be an option to postpone your business, the project, wherein if you wait, there would be someone else who would do the business first. Thereafter, you can be a challenger and do the business and reap the benefits of a challenger. Later on, other option which could be available is, once you are in a project, it is not necessary that you need to continue with the project until the end of the life of the project. For example, if you are in a mining business, it is probably unprofitable to still mine in the latter years of the project. It is possible that it is better to abandon the project rather than to continue with the project. These are the real options which your investment appraisal techniques are not able to take into cognizance. But you, as managers, as budding managers, have to consider that apart from quantitative techniques and financial techniques, we need to consider real life situations, real life options which are available, and also they take them into cognizance and do your calculations accordingly, and thereby make an informed decision. While we are in this capital budgeting techniques or the investment appraisal techniques, we should understand that while these techniques are very useful for a business to decide in which assets to invest, which assets to avoid, which is the best investment to make, there are inherent difficulties which arise because of using these techniques. The major difficulty is that since we are using numbers, we may lose sight of the real life situations, the real options which are available, such as an option to expand. It is possible that in the initial phase you might be getting a negative NPV in a particular project, but if you continue in the business, it is possible that over the years you will be able to expand and you will be able to generate much more profit NPV when you expand. So, in the absence of such a perspective, it is possible that you will reject a project which would actually be useful at a later point of time. Similarly, in business, we always try to be the first movers, whereas there might be an advantage to postpone our investment. Our DCF techniques do not consider prima facie this real option to postpone. Similarly, when we consider a project, we move with the assumption that we will stay put with the project till the project ends. But in real life, it is possible that you may be able to abandon the project towards the end of the lifetime, sell the project to someone wherein you will be able to generate better cash flows rather than continuing with the project. So, these are some of the real options which our DCF techniques may not be able to take into cognizance. To sum up, we may say that we have seen that we will be able to take informed investment decisions when we use these investment appraisal methods. We have used the traditional techniques, which are the payback method and accounting rate of return, and we have used the discounted cash flow techniques, which are more sophisticated, wherein we have used the net present value method, the internal rate of return method, the terminal value method, and the profitability index. I hope this lesson has been useful to you. Wishing you all the best. Thank you.
మా కార్యక్రమాలపై మీ సూచనలు సలహాలు తెలియజేయండి. మా చిరునామా డైరెక్టర్ ఆడియో విజువల్ ప్రొడక్షన్ అండ్ రీసెర్చ్ సెంటర్, డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ, ప్రొఫెసర్ జి రామరెడ్డి మార్గ్, రోడ్ నంబర్ 46, జూబ్లీ హిల్స్, హైదరాబాద్ 500003.